Right, it's 11 a.m., so I think it's about time to get going. So, welcome everybody, and thanks for joining us for this week's QuotedData's weekly show. James is having a well-earned rest today, so I'm going to take you through the news and things that have been going on in the world of investment companies, and then Rich is going to come on and talk to you about what's been going on in the world of real estate. And then Rich is going to be interviewing this week's special guest, which is Richard Moffat, CEO of Urban Logistics REIT. Now, it's sort of been a relatively quiet week in the world of investment trusts, but there's sort of few things. And I'm going to start with the noisiest thing, which is the sort of ramp up in the sort of war of words between sort of Tom and Lloyd Energy Impact Trust and the manager. Now, I thought it's worth just giving a bit of background to this because Thomas Lloyd is actually not that old. I mean, we must be at about sort of 20 months into its life. So I thought it was just worth having a quick recap of sort of what's happened with that so far. So TLEI launched in December 2021. It raised $150 million, which was a bit less than half of the sort of $340 million that it raised. And that actually included some support from the UK government. Now, its sort of aims are fairly noble. It was going to invest in a diversified portfolio of unlisted sustainable energy infrastructure assets. But the important point is this is really it's going to be doing this in emerging Asia, so sort of fast growing emerging economies in Asia, which is obviously going to be a sort of totally different kind of proposition to the sort of raft of renewable energy companies that we sort of currently have here on the London market. And obviously, there's a real funding gap for that. So, in many respects, sort of very ESG friendly aims. Key thing was once it was sort of fully invested, which should have been by the sort of end of this year, beginning of next, it was going to be targeting a 7% sort of annual dividend yield. That sort of total return of 10 to 12% per annum. So, and that was sort of after all fees, expenses, taxes, etc. So, sort of pretty compelling sort of overall proposition. You should hope to get some kind of capital growth in there as well. So sort of what's happened? Well, they sort of raised the money. Obviously, I said it was less than half what they wanted, but it was a decent pool, and they're able to get going and sort of start doing proof of concept. And the manager did precisely that. If you sort of look at our website, you'll see they started making investments in places like Vietnam, India, and the like. And everything seemed to be going okay. Well, at least from sort of outside perspective, until April this year, when the board suddenly suspended trading in the company's shares. And this really came out of the audit process. And the sort of board said at the time that as part of that, it had been made aware of material uncertainty in the value of an asset called Solar Rise, basically while putting together the annual accounts. Now, Solar Rise is a sort of Delhi-based renewable energy platform. The idea is it's going to have a sort of whole bunch of assets in there, and clearly I had a sort of decent stake in that. And there was one particular asset that was a problem, and this was a 200 megawatt construction ready asset. And we weren't really sure which asset it was at that time, but basically what they said was that supply chain difficulties, etc. And there were other issues that I'll sort of go on to. In essence, the costs of the components and actually putting this together, building it, had gone up materially. And as we now know, there were going to be sort of liabilities in terms of stepping away, and board were essentially assessing those. But because of this, and because it was so sort of close to the year end, they were not going to meet the sort of requirements for getting the accounts out on time, and the board just called time on it, which I think was a sort of sensible thing to do. There was sort of a bit of a gap before we got any sort of more serious information, but the sort of board gave a proper update on the 6th of June, and they revealed that the asset was this thing that we now refer to as the RUMS project, which is the Rira Ultra Mega Solar Park. What we now understand about that was that TLI was successful in bidding for it in July 2021. Obviously, negotiations then ensued, and all the documents were signed by November, and that's going to prove to be sort of key down the line. At that stage, they'd bid about $78.4 million, and that was going to be financed initially, majority with sort of debt and a bit of equity, but a mix of change over time. But it's targeting an IRR of 13.5%, which is pretty strong. And if you think about the sort of total return targets we were talking about, that's going to, exceed that. And so that was all done at the end of 2022, all documents signed, done and dusted, construction is going to start. But it's not until April that the shares are suspended, and the board then says that it's basically told by the manager at a meeting in April 23 that the sort of EPC contracts needed to be signed imminently. And it was also clear at that point, and this is important as well, that actually the costs had ramped up. And the board base said that was the first time that it was told, having actually asked the question previously. But let's continue. So, as I say, the big driver for this was the sort of big rise in solar module costs. Now, obviously, the supply chain issues, but actually a big factor here, I think, was the sort of relates to the sort of Modi Made in India program. But there's been a sort of big customs duty implemented on imported solar modules. It's 40% on those, and solar cells 25%. So you can see that's a big cost increase. And then when you throw in supply chain issues and you throw in inflation, etc., the sort of costs really ramped up. And what they said at this stage is if they just stop what they were doing, because they'd already started preparing the land, etc. If they halted construction, the SPV within which this sits would be saddled with 33.5 million of or US dollars of liabilities. I mean, it could be reduced with some mitigations, but that was sort of the serious figure that they were looking at. If they were to continue, then it was going to require an additional 50 million of funding. And I think there was already a bit of cash in the SPV, but basically they were going to need to put another $44 million into the SPV. And the overall project, if you looked at the sort of NPV of it and that present value, it was negative. So that would tell you that actually you should probably be stopping. And really, without any injection, if the project is seriously loss-making, why would you throw good money after bad? The SPV was going to fail, and that's what that sort of boiled down to. The next thing we sort of heard was on the sort of 13th of July, the board received a sort of requisition request from the asset manager. And basically, it wanted to put a sort of continuation vote in front of shareholders. Never heard of anything like this happening before, but I think the key thing is that it was a significant shareholder. I think owns about 15% of the fund through its sort of affiliates. And basically, it said, it was acting in its interests as a shareholder. Now, this is sort of quite unusual to see. I'm not saying that we haven't seen managers sort of do stuff that's contrary to what wider shareholders have and sort of block things. That has happened, but it's generally considered a major no-no. Good corporate governance, we like to see asset managers and boards aligned with the people whose money they're investing in, because if something goes wrong, they're all in the same boat, and it gives you an incentive to sort of try and sort those out, make sure that happen in the first place. But actually, where a asset manager is sort of forcing these kinds of actions, using those votes, or going against the will of boards and shareholders, that is a big sort of issue for concern. Obviously, it did this over the head of the board, which is, as I say, very, very unusual. And the board issued a statement and said it was very disappointed because at this stage they just didn't have any idea of what the impact was going to be of the sort of failing RUMS project. They'd not made significant progress with the audit. The sort of indication was that the manager wasn't providing the necessary information. And the key thing was that there just wasn't the information to make an informed decision about this vote that they were calling. Anyway, also at that time, it just didn't have any explanation of what the investment manager knew and what time about the RUM project. So really where things were going wrong. That was sort of kind of first indication that it maybe the manager had sort of known more, and perhaps the board knew that they'd known more. But this was the key thing that led to the suspension of the shares. Anyway, the key thing was the board put in place an EGM, which is due on the 21st of August 23. But as the board said, asking for this continuation vote when people don't really understand and don't have the information to make a decision isn't going to advance the production. If anything, it's probably like to hinder it, because it's additional things to look at. It's not going to advance the production of the annual accounts, which is the thing that has caused the shares to be suspended. Obviously, the board spent some more time considering this, and they issued a statement about 3 weeks later, and basically they voted unanimously, or recommended unanimously, against continuation. They reiterated their point that the annual report needs to be published first, and that actually continuing delays in finalising the valuations, specifically of RUMS, were holding this up. Some more information emerged at this stage. Apparently, the manager had appointed a sort of investment operations and risk advisory services firms to investigate the RUMS project specifically. But actually, initially it hadn't told the board and hadn't given the opportunity to sort of look into the scope of what they were looking at, or to even look at the output, which, is another big sort of corporate governance flag. They did, however, sort of share a copy of the scope, not necessarily the report, but the scope with the company's auditor, but told the auditor that they basically couldn't share the scope with the board, which sort of defies belief, really. Now, as I say, things then stepped up last Friday, and really, we've almost had daily announcements of this, both from the sort of board and the manager. But last Friday, the board received a second EGM request from the manager, and it's another sort of big corporate governance no-no. The manager basically says it wants to remove all of the members of the current board and put in its own people, which just, why would other shareholders that are not aligned with the manager even consider that? And as I say, I think the manager's got around sort of 15% that it controls. So, how it even hopes to achieve that, I don't know. As part of that, the manager also issued a statement refuting, the allegations made by the board when it recommended shareholders vote against continuation. It also said that it felt that if, there was a sort of continuation vote and, the sort of fund was stopped now, that it would immediately and permanently destroy shareholder value in TLEI. But to be honest, we couldn't really see any evidence of that. So that's something that needs to be explained further. It also pushes back and says that, although basically it didn't provide the information, the board ought to have known that component construction costs were continuing to evolve, which basically means they were going up. And this was evident. But I think the sort of question is, did the board ask about this and what was it told? And I think a lot more has come out in the subsequent days. So, let's quickly run through that. So that was sort of Monday. On Tuesday, the board revealed that a whistleblower at the manager had sort of come to them and provided information that confirmed the manager knew about the problems with Solar Arise long before it had told the board. And that sort of crucially, it knew about these things when it had told the board that there was no problem in sort of meetings in December 22. The sort of manager had said that, it's complying with all the requests, etc., of the auditor, and that, this should be out soon. And in essence, shares suspension should be able to be lifted. But, the board has said it's spoken to the auditor and says that the manager has no timetable for completing, the 2022 annual report accounts. And if that is so, and if it's not providing information as is suggested, then, there's no immediate prospect of a sort of lifting of that suspension. The other thing that sort of has come through in the manager's sort of commentary when it's been sort of making these, rebuttals and all the rest of it, is that, the sort of continuation vote is a binary outcome. And basically the board has said that is not the case. Yes, it will have to put forward proposals if the continuation, is sort of voted against. But actually, really, that appears to be what the board wants. And I think at that point, it would be easier for it to engage in negotiations with the manager. And it's sort of hard to see how this doesn't really end up in some kind of sort of separating or parting of the ways. But it says, the manager suggesting that it's kind of binary and there's this permanent loss of capital. And the board is saying no, actually, it just opens up our options. And one of those would be to sort of find a way forward, probably with an alternative manager, and presumably somebody's prepared to take this on. But I mean, there are issues about whether you would need to give people the option to get out at that point, and would the thing be sort of subscale, bearing in mind it wanted to be bigger in the first place. And now is not a good time to be raising some money for these things. I mean, we obviously don't have an up-to-date share price, but the sort of trend across the renewable space at the moment is significant discounts. If anything, there may be opportunities. Why would you put your money into something like this when perhaps you could, which probably be at par, should say, if they were doing a fresh capital raise, where you might be able to sort of buy a Bluefield Solar or a NextEnergy Solar fund at a sort of 20-ish% discount. It's going to be a sort of, you have to make strong arguments to get people to do it. Anyway, the other sort of thing is that the board had queried in December whether Solar Arise had enough money to meet all its obligations and get the project to completion. And apparently it was told that sort of cash had increased due to increased receivables collections. And actually, the rest will be sort of made up for the remainder of ongoing cash flows within solar, right? Because it's got these other projects. So basically, no problem. Whistleblower says that actually the manager knew as early as August 22, so long before that December board meeting, that costs has increased significantly and that a capital injection would be required. The board says it didn't actually know this till, where are we, about 8 months later. And the sort of information that's been received from the whistleblower suggests that the manager made a deliberate decision not to inform the board about the problems. Now, so where do we go here? I imagine that both sides have probably got lawyers sharpening their pencils as we sort of speak. I would have thought that we could easily see either, action by the board against the manager or by shareholders against the manager, because to be honest, there's a lot here that doesn't look right. Anyway, another day, another set of sort of statements. So Wednesday, Thomas Lloyd issued a rebuttal. It said that the sort of board's claims about the sort of project were theoretical. Basically, it was saying the sort of situation has improved a bit. Construction costs are coming down, component costs are coming down, capital requirements are therefore falling. It thinks it can proceed with the project without sort of breaching the sort of company's restrictions. But however, I think the sort of thing that really stood out was its statement that we failed to understand why the TLEI board, as a non-executive board, would expect to see the investment manager's internal working documents, including presentations and financial models. And you have to ask yourself, it's a serious question of whose interests are the manager actually serving at the moment. Doesn't really appear that it's sort of shareholders, not fully anyway. So fast forward to Thursday, we get another response from the board. And basically it said that statements it made in the previous day's announcement weren't false as sort of claimed by the manager, but are supported by verified documentary evidence. And it said the manager's claims that the sort of assertions about the RUMS project are theoretical, or at best misleading. It said, returns are increasing, but a very low base. Basically, the NPV is still, this thing is still seriously negative. It also says that there is no evidence the manager can realistically deliver on its aims of publishing the accounts by the end of September. So, if that's the case, expect the shares to be suspended for at least another couple of months. But this was the point I sort of pulled out before. It says the investment manager appears to misunderstand its key role in relationship with the company if it does not see why material information should be provided to the board. It basically goes on to say, the board is obviously there to provide oversight. And if the manager won't provide the information that it needs, then how can the board do its job? And it should know that it needs to answer the board's questions. Now, I think that's sort of basically the summary where we are. There's sort of no more today as of this morning, so maybe a bit quieter for longer. My view is that the manager doesn't seem to know what its responsibilities are. I think, the sort of prospect of retaining the entire board, sort of kicking out the entire board and replacing with one entirely selected by the manager, just seems ludicrous to me. But I think obviously investors will have to have a look and think about what value may or may not sort of be extracted. I think the whole situation is quite sad because it did start with sort of very sensible aims and offered something completely different. But I think it'd be hard for anybody else to kind of come along and raise money to do this, just given the way that this has gone so impressively wrong. But anyway, that's enough on TLEI. Let's look at Riverstone Energy. So they came out earlier this week. They are going to be doing a sort of tender offer for just over 30% of the fund. Now, basically, as it's been sort of running off its projects, it's been building up a lot of cash. Now, obviously, historically, it's been invested in sort of oil and gas sector. Its idea is to convert itself to a renewable energy fund. And in terms of, oil and gas, it's been doing very well in terms of receipt. And it has been, hoarding this cash. And it says of this 123 million, it plans to use about $100 million or 18 million pounds to fund a tender offer. Now, that is sort of potentially quite interesting. But the sort of thing that is perhaps disappointing with this is that whereas you would usually expect a tender offer such as this to be done at sort of NAV less costs or NAV perhaps with a sort of 2% discount to allow costs, and just to give a little incentive for those that are remaining. It's actually going to be done at the sort of closing price on the 16th of August, which was 105.78 pence per share, which is a 43.5% discount to NAV. I mean, this just sounds, excessive. You're going to see a significant transfer of value from shareholders who tender their shares to shareholders that decide to sort of remain in the fund. And at a sort of quick grasp, I don't know why people would sort of go for this. I think, as I say, something that was somewhere in between probably wouldn't have been that well received by the market. I think there would have been sort of arguments that it should reflect something much closer to NAV, but you could see it would give people a sort of reason to get out. I don't understand why a tender offer that's at the sort of current share price, give or take, is going to be helpful. As I say, it just kind of pitches one set of shareholders against another. And I don't see, if you feel there's a spot, clearly there is a significant overhang in the stock, but I don't see that helps to get anybody out. It just, doesn't. That said, we will see some people are likely to take it up, but I think it just will show how desperate investors are for liquidity in this. If the tender offer was taken up in full, you're basically going to see the sort of NAV rise from 10.23 per share to 12.17. As I said, I just don't see that, but that is the sort of theoretical uplift that you could see. So about £1.94 for remaining shareholders if, all tenders are submitted and accepted to the maximum level. It's going to require shareholder approval, and there's an EGM on the 27th of September. And if you tender your shares, you can expect cash around 6th of October. Now, I just thought this bit was quite key. It says no directors will tender shares owned or controlled by that director in the tender offer, nor will shares held by any entities affiliated with the investment manager. So in essence, the manager and the board are staying in. So, like other shareholders, they will benefit if that goes up. Just to sort of give you a look, I cast this last night, but really, de minimis impact on the sort of share price. And obviously, there's been a bit of a leg down in the NAV during the last 6 months. But actually, broadly speaking, the sort of discount that was, around 55% has sort of come up to, late 40s, which is a significant discount. I mean, a lot of people may well say that it's a buying opportunity. So, why tender your shares? But I say more food for thought. Next thing I want to discuss was Blue Solar NAV update. I'm going to do that, and then I'll do NextEnergy Solar next, because they came out this week on the same day. Thought it was worth talking about because there are just a lot of moving parts. The NAV's not necessarily moved a great deal, but actually there's quite a bit going on underneath the surface. So in essence, in the sort of Blue Solar NAV update, the NAV's increased by 0.8 pence per share. They have increased the discount rate by basically 0.25%, from sort of 0.75 to 8%. And the impact, not surprisingly, is it's sort of taken a chunk off the NAV, 4.9 pence per share to be precise. On the other side, sort of power prices have fallen, but as we've sort of long discussed, Bluefield has been quite shrewd in the sort of way that it has put in place PPAs for a sort of chunk of the portfolio. It's tended to put more in place when prices are high, less, and sort of expose yourself to more merchant risk, so potentially get upside when prices are low. It's been pretty successful at this. So although prices have come off a bit recently, actually during the period it's locked in some higher prices through PPAs, and basically this is added 3.1 pence to the NAV, but it's also generated an additional 3.5 pence of working capital that also flows through to the NAV. As we've often talked about with these funds, there is sort of very strong inflation linkage within them, sort of subsidy revenue, etc. And basically, there has been an increase in inflation assumption, and that's added 2 pence per share to the NAV. The other thing, they've managed to sort of bring forward 2.3 pence in terms of progress with the development pipeline. Now, this sort of relates to the solar and storage development projects. As you can imagine, as these things hit sort of various milestones, so you've got to secure the site, you've got to sort of secure the planning permission, you've got to secure the grid connection, you've got to secure, EPC providers, etc. You've got to buy the components, you've got to get a constructor builder, etc., etc. But as you hit those, the project becomes de-risked. And as it becomes de-risked, you can reasonably apply a sort of lower discount rate. So often they'll start up quite high, lower discount rate to the sort of projected cash flows, and it generates a valuation uplift. This applies to all of the projects and all of these sorts of renewable infrastructure funds. So you see this as they sort of get de-risked. In this case, I say it's added 2.3 pence to the NAV over the quarter. That covers all of that. The only other two sort of moving parts were the change in debt structure. This has, not surprisingly, with sort of interest rates higher than they were, knocked off 3.1 pence per share, and other movements have basically taken off another 2.3 pence per share. Other things that came out in the announcement is that sort of Bluefield has reaffirmed that it's going to sort of pay a full year dividend of 8.4 pence for year ended 30th of June. This could be, there's obviously still working through accounts, but it looks like it could be more than twice covered sort of by earnings, and that's after the debt amortization as well. We'll know more sort of end of September when the results come out on the 28th. Currently trading at a sort of 20.8 discount to NAV, dividend yield of about 7.6%, which I say is pretty chunky. Just to give you sort of some idea, there's been quite a lot of movement, and I think it sort of reflects sort of rising interest rates, sort of depreciating sort of economic outlook, as it were. But there's sort of been quite a leg down in the share price, even though actually the NAV has been holding pretty firm. So discounts sort of gapped out. If you sort of look back, a year or a bit longer, for a long time, this consistently traded at a sort of hefty premium, just reflecting the demand for these assets and a sort of low interest rate environment. Of course, with interest rates rising, you've got all funds generally, but particularly sort of alternative asset funds. If they've got debt in the capital structure, there's a cost there. You've got high discount rates, potentially on the sort of discounted sort of cash flows. But the other thing is, if you can get 4.5% off gilts, then there's going to be less demand for these sort of additional assets. Let's have a look at NextEnergy Solar. So similar sort of story, but basically there's been a reduction in the NAV. Once again, a lot of moving parts. The big thing is actually they've increased discount rate by 0.75%. So that's 3 times what Bluefield is. But actually, if you look through that, both end up with a sort of weighted average discount rate of about 8%. So actually relatively comparable at this point. They say the increase reflects higher interest rates, sort of both short sort of base rate costs, but also sort of longer term risk-free rates costs, plus deteriorating macroeconomic outlook. This took sort of 4.7 pence per share off the NAV. Just to give a breakdown of that, because they do give a little bit more. UK unlevered assets are now valued using a 7.5% discount rate, so that must have been 6.75 before. UK levered assets, there's a bit of a range on those, sort of 8.2 to 8.5%, but you can see they probably would have been, sort of 7.5 to, above. Italian assets, 9%, so, that would have been below 8s. And subsidy-free contracted assets and projected returns beyond a 30-year asset life, so this comes all back to the sort of DCF calcs, 8.5%. What's sort of driving this? Well, higher near-term inflation assumptions, but equal offset by sort of lower long-term inflation rate assumptions. These have added about 0.7 pence per share. Once again, power price forecasts have changed slightly, but not by much. But it's sort of taken 0.3 pence off the NAV. As I said before, sort of weighted average discount rate is now 8%. Interestingly, and obviously this is a debt equity mix, but it's got a weighted average cost of capital, 6.2%. So obviously sort of well above that. But these were sort of 5.7 and 7.3% at the end of March. Total gearing, including prefs, so pretty sensible, 45%. Interesting thing, sort of despite all the macro noise, portfolio generation actually pretty decent outperformance, 3.9% for the last quarter over budget. NextEnergy Solar in the current sort of fundraising environment have said actually they want to do a sort of capital recycling program. That's something they've been working on. They've been making progress with that. So there's a sort of sales process for selected subsidy-free assets ongoing, and they're making progress with that. Similar sort of discount to Bluefield, as I said, 20.3%. Once again, you couldn't get that anything like that a couple of years ago. Dividend yield 9.1%. Once again, just have a look at this. Not really sort of great deal move in the share price, but you can see sort of fairly decent discount to NAV. I think now it's time to hand over to Rich.
Great, thanks, Matt. I'll just share my screen. Full screen. There we go. So yeah, a couple of bits from me. I'll wrap through them quite quickly. So Ediston Property first. So you remember a couple of months ago, or more than that, in March, the board launched a review into the company, which could have ended in a merger or an acquisition. And there's been reports this week that Realty Income, which US REIT is close to agreeing the deal to buy Ediston's portfolio. It was also reported that Aberdeen, New River REIT and Custodian REIT were also in the frame. Still could be, which would be interesting. No price was mentioned, but he did say it was be a significant premium to the share price on that day, which was 65. It's jumped up a bit to 69.8 last night, which is still a sort of 13% discount to its NAV. I would imagine the price would be a slight discount to NAV, but well above still the 69.8 is today. So like I said, they launched a review in March, frustrated with this wide discount, which a lot of REITs are at the moment. This portfolio is predominantly retail parks, got 11 assets across the UK, and supply and demand, although this is retail, retail parks are slightly different to other parts of the retail sector. So supply and demand is pretty good. They're sort of edge of town locations. Discount retailers are growing, and that's a big part of the demand side there. And they're on sustainable rents, so you're not going to get over rented and valuation depreciation from that. So pretty good company in my eyes. Surprised it's been on such a wide discount for so long. As you see here, COVID came in, took the discount right down, but it did come back last year, and then obviously you had the inflation and interest rates going sky high, and it's just dropped back down again. And obviously the board can't see any way of growing. So be interested to see if that goes through and at what level the pricing is. And hopefully, I mean, we've seen it before with other M&A at the moment in the sector. That hasn't really, even though prices are massive premiums to share prices, it hasn't really impacted the rest of the sector, which is a bit puzzles me a bit. And the other one I wanted to talk about was Empiric, who have also struggling with wide discount to NAV, but they reported half-year results yesterday to the end of June, and they were pretty good actually. NAV was up 1.6%, portfolio was up 1%, which in these times is pretty good. So just over £1 billion there. Revenue up 16%, earnings up massively as well, and it's pretty conservatively geared as well, so 30% LTV, which is good. The interesting point for me going forward, I mean, this fund was massively hit by COVID, which saw occupancy drop to about 60% for obvious reasons. But for the upcoming academic year, which starts in September, they're already 98% occupied also. So they've let pretty much all of their rooms already, with a few weeks to go, and they're looking at 9% rental growth for the next year, which is really good in this market. And it seems that their strategy, which was launched about 2 years ago, sort of their turnaround strategies is really coming to the fore now. So they got this, what they call a cluster strategy. So they assemble lots of assets close to each other in top university cities, so they can share amenities like gyms and things like that in one big site, and all the other sort of smaller satellite sites have access to that, which obviously drives costs down. Operational costs are obviously smaller as well, because you have one team looking after more assets, and then obviously gross margins are higher. So that's the plan, and it seems to be working. They've identified a lot of assets that wouldn't fit into this model, so they're on a disposal spree at the moment. So they've sold about 100 million over the last couple of years, all above book value, which is good, especially in this market. And they're recycling that money into their existing portfolio, sort of refurbishing rooms up to a higher standard, and they've been achieving sort of 9 to 11% IRR on that, with the higher rents that they can then charge. Another interesting point is the postgraduate market. It's massively growing in the UK. It's now almost 30% of the student market is postgraduates. That's grown almost 40% since 2011, and it may take a bit more to refurbish the rooms. Might cost a bit more, but they can charge 20% premium on their existing sort of portfolio, which achieves about 14% IRR. So this is something that they're really looking to grow. Problem is, like I said earlier, they're on a 30% discount or 25-30% discount, and they're finding it hard to grow. Obviously, can't raise capital at that discount. Debt's too expensive at the moment. So they are, which they announced yesterday, exploring bringing in a joint venture partner. So the joint venture will put up some capital. I'm sure Empiric will put up some capital as well, to acquire new assets and refurbish existing assets in their portfolio into this postgrad product, which, like I said, gets higher returns. They've identified 150 million worth of assets in their existing portfolio, which costs about 40 million to upgrade. And there's loads of other targets in their target university cities that they can acquire and then refurbish once they've acquired. And I think the way it would work, that Empiric would operate the assets under their Hello Student brand and earn fees as they do that. So that's an interesting way of growing in this current market, and it'll be interesting to see what comes of that.